Roger Montgomery from rogermontgomery.com. I'm a contributor to the Eureka Report and also the author of the value investing book, Value.able. What I'd like to do today is show you how I go about value investing, how I identify wonderful businesses, how I decide whether they're any good or not, and how I work out what to pay for them. So come with me as I show you precisely how to do that. To invest successfully in the stock market requires three things. You have to be able to avoid the bad businesses, identify the extraordinary businesses, and know what to pay for them. I'm going to show you all three steps today, but before we do that, there's one more thing, and that is you need to think right. What most people tend to do is they tend to focus on stocks rather than businesses. So they buy a share on the stock market hoping that it'll go up. What I'm proposing is that you think about the underlying business. Buying a share hoping that it goes up is the same as betting on red or black at the casino. And for most people who do it, the returns are about the same. I'm suggesting instead of focusing on stocks, you think about businesses. And the other thing that you need to do is instead of focusing on prices, you need to focus on values. We're obsessed with the price of everything. Every day the stock market report comes on and somebody will tell you that the Dow Jones went up or the Dow Jones went down so many points, that Amcor's shares went up in price or David Jones' shares went down in price. On the weekend, house prices went up by this much. We're obsessed with prices when really we need to turn the stock market and its distracting prices and noise off and just focus on the values. The values of businesses change much more slowly. Think of Telstra. Its share price can swing around 3% in a day. The value of the business doesn't change that much. Once you get that right, once you start thinking about businesses instead of stocks, and you start thinking about values instead of prices, you're well on your way to becoming a successful value investor. Step number one is to focus on good businesses. What do they look like? The first step in this entire process is the extraordinary secret to identifying great businesses. And the secret is this: avoid the bad ones. What I'd like to do now is show you what a bad one looks like and how to think about all listed companies the same way. I want you to imagine I'm going to run a business for you. You're going to own it, you're going to fund it, I'm going to run it. It's the year 2000. You contribute some of your money and you're going to put in $2.9 billion of your own capital. We're also going to go down to the bank and we're going to borrow $3.1 billion. So we'll call that equity and that debt. And I run the business for a year. And after a year, I report to you a profit of $517 million. Now, you look at that result and you compare it to the equity that you've put in the business, $2.9 billion, and that works out to about 17.5% return on your money. That's a good result. You'd be delighted with it. You can't get that result in a bank account. So encouraged by it, you asked me to continue running the business. Now fast forward to 2010. What if I told you that the business is now generating a profit of $130 million? Not $517 million, but only $130. Not only is it down, but after inflation, it's down a lot. I think you'd agree with me, that is not the recipe of an extraordinary business. That's a bad business. But that's not the full story. It's not only the profits coming out of the business that I'm interested in, I'm also interested in how much money have you had to put back into the business. What if I told you that in addition to the $2.9 billion that you've invested back in 2000, you've put in an additional $2.9 billion. You've now got invested $5.8 billion of your money in this business. The return, $130 million on $5.8 billion, would be less than 2%. You can get a better return in a bank account with no effort at all. What if in addition to that, I told you that you've borrowed more money since the loan of $3.1 billion 10 years ago? What if I told you that you borrowed an additional $2.4 billion? Do you think that's the recipe of an extraordinary business or a bad business? I think you know the answer to that. But you know what? This isn't a make-believe company. This is a real company. This is Qantas. And these numbers come from the annual report. You can see this is a business you wouldn't want to own outright. And Warren Buffett said, if you're not prepared to own the whole business for 10 years, don't be prepared to own a little piece of it for 10 minutes. So that's not an extraordinary business. But what's the point of telling you to avoid these businesses if there's no relationship between their share prices and their performance? Well, I'm happy to report that there is a relationship over a long period of time between the share price and the performance of the business. Come over with me and I'll show you what Benjamin Graham said about this. Benjamin Graham, back in the 1940s, said that in the short run, the market is a voting machine where the voters have a registration test, if you like, but they are neither intelligent nor emotionally rational. What he was saying that is, in the short run, the stock market's a popularity contest and share prices move around very quickly, and the people moving the share prices around are neither intelligent nor emotionally stable. But he also said this, in the long run, the market isn't a voting machine, it's a weighing machine. In the long run, prices tend to follow the performance of a business. If that's true, over the long term, the share price performance of Qantas should be low because the performance of the business itself was low. Here is the share price of Qantas over the last 10 years. And what might surprise many investors is that the share price of Qantas today is less than it was a decade ago. Now, some of you might be saying, well, what about the dividends? Well, in reality, the dividends have been suspended. Qantas doesn't pay a dividend, it hasn't for some time now. They may start again, but cash flow's under pressure. So the performance of the shares has tracked the performance of the business. And you can see that here. What I've done here is I've turned the performance of the business into a value. We're going to talk about values in just a minute. But you'll see that the performance of the value of this business is unchanged. The value of Qantas is no higher today than it was 10 years ago. And the share price is going to do about the same thing. The lesson from all of this, avoid bad businesses. What I'd